What is a financial statement review, and why do you need one? A review is a middle ground between an audit and a compilation. And so let me just explain what those mean. An audit is the highest level of service that a CPA can provide. It involves the CPA going in and examining the records, independently verifying information, doing an assessment of internal controls, and a number of different things. So the CPA can provide a very high level of service because they've done a lot of extra work on the financial statements. And so when a CPA issues an opinion on an audit, the opinion says that the financial statements are free of material misstatement. On the other end of that spectrum is a compilation. And a compilation can be issued in a number of different ways. The CPA doesn't have to be independent to issue a compilation. But a compilation is just the taking of the client's books and records, or the information that the bookkeeper provides, or the spreadsheets, or whatever that information is, and putting it into proper financial statement format. And that financial statement format comes in the form of various financial statements as promulgated by the AICPA or whatever governing body that you're trying to issue a financial statement under. So typically we'd have a balance sheet, an income statement, a statement of retained earnings, and a statement of cash flows. And then in a compilation, and this is where it's a little bit different, a compilation allows you to say, well, I'm only going to issue the numbers on that financial statement. But rather, in a review and an audit, you also have to issue note disclosures and explain what the company does, and explain the terms of the loans, and explain the accounting policies, and a number of different things. So a review sits right in between those. And let me just go back real quick. On a compilation, the accountant provides zero assurance, meaning they don't issue an opinion. And it actually says that in the letter that we put on our letterhead in a compilation. It says, we have not conducted an audit or a review, and we don't issue any sort of an opinion on these financial statements. In a review, we sit right in the middle of the spectrum between an audit on one side and a compilation on the other. So the review's right smack in the middle. In a review, the CPA issues limited assurance, or sometimes known as negative assurance, right? In an audit, we say the financial statements are free of material misstatement. In a review, we say we're not aware of any misstatements in these financial statements. So we're not saying that they're free of them. We didn't do that level of work, but we did do a number of inquiries and a number of things that allow us to say we do have an opinion. We don't think that there's anything wrong. So a lot of times when a company is looking for financial statements, they're looking for something to provide to somebody else, right? Whether it be a bank or a lender or an investor or an exiting partner or whatever the case may be. There's a number of different reasons why somebody would need a financial statement. I'm going to focus mostly on what banks need. We have a number of relationships with different banks, from the local smaller banks to credit unions to the large, sort of national banks. And almost across the board, if a company is coming in and they have 1 or 2 years of operations where they've made some profits, and they're looking for maybe a line of credit to obtain financing so they can fix seasonality of their business, or they can inject money and do certain things and grow, the bank is looking for some level of assurance on those financial statements. And if the company's going in and they say, well, listen, I'd like a $100,000 or a $200,000 line of credit, and they have the receivables to support that, well, the bank will often just issue it based on tax returns or maybe compiled financial statements. But when you get to, and this is just based on experience, and it's going to vary from bank to bank, but when you get from $300,000 to $500,000 or more than that, the bank is looking for something a little bit heavier to support the borrowing that the company is looking for. And that's where a review comes in. So below $500,000, you can get away with a compilation or even just financial statements. Above $500,000, the bank was going to want some assurance. And this is going to be an annual requirement. Banks are going to require you to issue a financial statement every year from, while you have the loan, because they need to make sure that you have the ability to pay, that you're meeting certain restrictions of the loan, meaning you're not going out and borrowing other money on top of the money that you borrowed from that bank. So the bank is going to need the financial statement just to have the assurance that that your company is performing the way that you say that it's performing. And it's going to have the weight of an accounting firm that has issued even a limited level of assurance on the accounting firm's letterhead behind it. And so I want to just talk quickly about assurance and credibility, because I've said those two things a couple of times. Assurance is the level of service that the accountant provides. So in a compilation, we provide zero assurance. In an audit, we provide a large amount of assurance. And in between is a review where we provide a limited amount of assurance. Credibility is the result of that assurance. So when we issue a financial statement, it's a very credible financial statement, meaning our reputation is behind it. It's on our letterhead. And what's interesting about accounting firms and the accounting industry in general is that we all follow the same rules. We have to follow the same steps and procedures in order to issue a review or issue an audit across the board. So it's not just the accounting firm's reputation, it's the accounting industry's reputation. And that's why a financial statement review, audit, or compilation issued on accountant's letterhead is so valuable for a client. All right, so why don't we talk about a few of the reviews that our firm has issued, or I personally even issued, and how they and what those clients needed and what they were looking for. So I have a construction company client. They do institutional work, and in order to do that level of work, it's not just going into somebody's house and changing out a window. They're doing work for large public institutions. And in order to do that sort of work, they need to have the insurance to do that sort of work. And that insurance is called bonding. So bonding is an insurance to perform a job that you were expected to perform, even if your company doesn't actually complete it. So there's bid bonds, there are performance bonds, and there's other sort of bonds that sort of sit in between those. My client, they get bid bonds and they also get performance bonds. And their insurance company requires them to issue a financial statement every year in order to obtain that ability to do the institutional work that they do. So without having our review level financial statement, they would be unable to do the work that they do, right? So it's very important for them for every year to have a timely issued financial statement. I have another client, and they are a wholesale distributor. And in order for them to distribute their goods across the world, they rely on bank financing. So letters of credit, lines of credit, term loans, and other things that allow them to sort of buy and sell, and they make profits based on that. And those loans, because there are a number of different institutions, all require this client to have a review level financial statement. So in prior years, they had audits, and when we reviewed the loan documents, we realized all of the years that they were doing audits, they weren't even required to, because the loan documents only require them to have a review level financial statement. And so we were able to save the client a little bit of money by stepping down from an audit to a review, and then allow the client to continue to operate and borrow the money that they need to borrow in order for them to conduct the business that they do. All right, I have another client, and they are a manufacturer. And this client they had a timeline in mind of when they were thinking they were going to exit this company. And so 3 or 4 years before they started thinking about exiting the company, they asked us to come in and start issuing financial statements for them. And they had never really issued financial statements before, other than compiled level financial statements. But we started doing a review for them, anticipating that at some point in time, they're going to sell this company. And for 3 or 4 years, we issued the financial statements. And then ultimately, they came in and had an investor come in and purchase the company. And without the limited assurance of a review level financial statement, they would not have been able to attract the investors that they attracted. And so the review level financial statements were very important for them, actually integral for them in selling the company when they did. Another company that I issue a review level financial statement for is another construction company, and they do municipal work. And similarly, similar to the industrial client that has bonds, this municipal work also requires bonding by an insurance company. And without the review level financial statement, the client's unable to even bid on jobs for various towns and municipal agencies across the state of Connecticut. So our review level financial statement sort of unlocks the ability for them to do the work that they do. So if any of these stories that we've told or examples that I've provided ring true to you, and you think that maybe you need a financial statement review or a compilation or an audit, we're here to help you and we can walk you through the process without any problems. Please give us a call.